So imagine stepping into just a massive global party. Like the music is absolutely blaring, the champagne is flowing, everyone's celebrating.
Yeah, that's exactly the vibe across global financial markets today.
Right. Because a major geopolitical event, the Iran-US ceasefire, has just been finalized. So the tension has snapped, the flags have come down, oil prices are tumbling, and equities are surging from, Mumbai to New York.
Risk assets are looking fantastic.
Totally fantastic. I mean, if you look at your portfolio right now, it is probably just a sea of green.
It's the textbook definition of a relief rally. And, well, on the surface, the logic actually holds up. De-escalation historically means a reduction in forward-looking risk.
Makes sense. Less risk, prices go up.
Exactly. When perceived risk drops, asset prices rise. The market is looking at the ceasefire and, breathing this collective sigh, just assuming the crisis is entirely in the rearview mirror.
But today's deep dive is really for you, the listener, who wants to see past that superficial celebration. Because we've got this fascinating sovereign debt dispatch in front of us, and it makes a really compelling and honestly slightly terrifying argument.
Yeah, terrifying is a good word for it.
The dispatch claims the market is basically suffering from a severe case of amnesia. So we're going to explore why stopping the bleeding doesn't, magically put the lost blood back into the patient.
Right, because the market is currently pricing this ceasefire as a complete zero-sum resolution. Like, the threat is gone, therefore the problem is completely solved.
Which is a huge assumption.
A massive one. What our dispatch today outlines are the hidden multi-billion-dollar hospital bills left behind by the conflict.
Stuff nobody wants to talk about at the party.
Precisely. We are going to unpack the quiet structural damage inside three major central banks, India, Turkey, and Pakistan. And then look at why the Mekong region, specifically Vietnam and Cambodia, reveals deeper systemic cracks that the broader market is just, well, completely ignoring right now.
Okay, so let's unpack this concept of the Amnesiac Rally, because that framing is really what hooked me when I read the dispatch.
It's a great term.
It is. So the dispatch argues that the market is accurately pricing the forward risk, meaning, the war is over, no new bombs are falling, shipping lanes are reopening, but it's completely forgetting to price in the accumulated cost, the buffers that were burned just to survive the last few months.
Yeah, the survival cost.
But I have to admit, I'm struggling with a disconnect a little bit here. I mean, if the threat is genuinely gone, shouldn't the risk premium drop? Like, isn't the market technically right to throw this party?
Well, the market is right to celebrate the end of the flow of new damage, sure. But where the amnesia kicks in is by totally ignoring the stock of damage that has already accumulated.
The stock of damage,
yeah. It's the difference between the acute phase of an emergency and the grueling reality of a recovery phase. A professional bondholder, they have to distinguish between a threat receding and the permanent cost that the threat inflicted while it was still active.
Okay, it sounds like it's like discovering a massive leak in your roof during a terrible storm.
Right.
You finally get an emergency plumber out there, they patch the hole, and you throw a huge party to celebrate the dry floor. But you're completely ignoring the fact that you just drained your entire savings account to pay the plumber's, crazy emergency weekend rate.
That is a highly accurate way to look at it.
Yes, the roof is fixed, and no new water is coming in, but you are structurally much poorer and much more vulnerable to the next storm than you were a month ago.
Exactly. And this isn't just theoretical hindsight from the dispatch. I mean, we can look back at the IMF's Regional Economic Outlook for the Middle East, Central Asia, and Africa. This was issued back in October 2025.
Oh, right, the October report.
Yeah, and the IMF explicitly warned that oil-importing sovereigns, so countries with high fuel subsidies and a really heavy reliance on imported energy, were incredibly vulnerable to an escalation scenario.
Right, because if oil prices spike, their import bills just skyrocket overnight. They have to pay so much more just to keep the lights on.
Exactly the mechanism. And that vulnerability wasn't just some worst-case scenario model. It actually happened. The vulnerability was realized in real time during the conflict.
The storm hit.
The storm hit. And the ceasefire today removes the ongoing escalation risk, sure. But shaking hands on a peace deal does not magically refill the import cover ratios or the bilateral deposit buffers or the gross reserve positions that these countries just burned through to keep their economies afloat while the war was raging.
So the consensus trade right now is just pricing in the handshake.
Right. But the bill is still in the post.
Okay, let's talk about how these countries actually paid that plumber, so to speak? Like, how do they drain their savings without anyone really noticing during the chaos? Because the dispatch uses India as a prime example, and what the Reserve Bank of India, the RBI, did, it seems almost like an illusion.
It really is a masterclass in stealthy economic adjustment because to understand the structural damage from the Iran war period, you can't just look at the price of oil.
Because that fluctuates anyway.
Which you've read. Right. Oil prices will eventually mean revert, as we are seeing right now. You have to look at what central banks spent behind the scenes to prevent price discovery in their domestic foreign exchange markets.
Okay, break that down for me.
So during the conflict, India faced a massive current account shock. Energy prices spiked, putting severe downward pressure on the value of the rupee.
Right, because they had to convert more rupees into dollars just to import the exact same amount of oil they needed to keep the country running.
Yes, which naturally should cause the currency to depreciate. Now let's look at the IMF's Article 4 baseline for India, which is essentially, the IMF's regular deep dive health check and economic projection.
Their standard physical.
Yeah. They assumed India's foreign exchange reserves would remain stable. They projected India would maintain above 10 months of import cover, providing a really solid buffer against global shocks.
Let me stop you there for a second, because I always see that term, import cover, and I just sort of nod along. But what are we actually measuring there? What does that mean?
It's a very literal metric, actually. It measures how many months a country can survive and keep buying absolute essentials from the outside world, things like oil, food, and medicine, if all other incoming revenue suddenly just stopped.
Oh, wow. So it is the ultimate national emergency fund.
Exactly. It's the rainy day fund.
Got it. So the IMF thought India would keep 10 months' worth of emergency funds safely tucked away.
They did. But instead of letting the rupee weaken naturally under the pressure of the conflict, which, would have imported a lot of inflation, the RBI chose to absorb the shock themselves. They actively defended the currency by selling off their dollar reserve.
And this is where the mirage happens for the average investor, right?
Exactly.
Because this strategy makes the economic damage totally invisible if you're just pulling up a chart of the exchange rate on your phone. Like, the rupee looks completely stable, the price data looks fine.
Perfect.
But every single dollar the central bank spends artificially defending that exchange rate is a dollar permanently removed from their safety net. You're maintaining the illusion of wealth by quietly, selling off the furniture.
Yeah, that's a great way to put it. And there was reporting just this week that India's FX reserves declined sharply because of the RBI's reluctance to let the currency float.
Wow.
That is a material negative deviation from what the IMF had modeled. The ceasefire stops the rapid outflow of reserves, sure, but it does not put those billions of dollars back into the RBI's vault. That safety margin has evaporated, and it takes quarters, sometimes years, of steady exports to rebuild it.
Man. So India is a fascinating story of quietly draining the tank. But the transition here is really jarring when we look at Turkey. Because if India spent its own actual savings to weather the storm, Turkey's situation feels entirely different.
It is fundamentally different. I mean, India had buffers to burn. Turkey did not. If we look at the IMF's 2025 Article 4 for Turkey, the absolute headline metric for their economic recovery, like the ultimate proof that they were finally turning things around after a very fragile, highly inflationary period, was reserve rebuilding.
They desperately needed to show global investors they were stacking cash away.
Yes, exactly. But the dispatch pulls a staggering number out of the data. In March alone, Turkey's central bank arranged $20 billion in gold sales and FX swap instruments just to sterilize the shock of the conflict.
Wait, $20 billion in a single month?
In 1 month.
Okay, sterilization, FX swaps. Break the actual mechanics of that down for me. How does a country even do that?
Think of it this way. You want your bank account to look incredibly flush right before a loan officer checks it.
Okay.
So you take a valuable asset, in Turkey's case, gold or even future currency commitments, and you essentially pawn it for US dollars through a short-term swap agreement.
Oh, wow.
You put those dollars on your balance sheet so your gross reserves look fantastic, but you owe those dollars back, often with interest or at a set exchange rate.
Right, it's not actually your money.
Exactly. So sterilizing the shock means they are using these complex, borrowed instruments to absorb the blow of the energy spike without letting the lira collapse.
So they're basically padding their checking account with a payday loan.
Pretty much.
And that $20 billion intervention in March, I mean, that's not a small adjustment.
Not at all. To put the scale of that in perspective, that single month of extraordinary intervention wiped out 6 to 9 months of the IMF's projected reserve accumulation.
6 to 9 months gone in 4 weeks.
Yes. In 1 month, the entire long-term narrative of rebuilding buffers was just reversed. And the key takeaway here is the difference between gross and net. Net of those swap liabilities, Turkey's usable, unencumbered reserve position is materially worse than the gross headline figure that gets blasted across the financial news.
But the market just sees a stable lira and assumes the recovery is on track.
They do.
But the lira's stability is borrowed. It's not earned through organic economic growth or exports. It's just propped up by emergency gold sales and these really complicated currency swaps.
Which transitions us to an even more precarious situation. I mean, India burned its own internal reserves. Turkey borrowed internal stability at exorbitant costs. But what happens when a country starts losing its external lifelines?
Oh, this brings us to the situation in Pakistan.
Yes.
The Dispatch calls this the most consequential data point of the week, which is a really big claim. It points to Pakistan's $3.5 billion repayment to the United Arab Emirates. And, on the surface, a country paying back a debt sounds like a good thing, right? Why is this so critical and so dangerous?
We have to look at the architecture of Pakistan's survival. Their entire IMF Extended Fund Facility, which is, frankly, the only thing keeping them from default, relies heavily on bilateral creditor relationships.
Okay.
Specifically, it relied on things like that $3.5 billion deposit from the UAE acting as a, quote, financing assurance.
The financing assurance.
Yeah.
How does the IMF use that?
The IMF basically acts like a really conservative mortgage lender. They tell a struggling country, look, we will lend you this money, but only because we see that your wealthy friends in this case, the UAE or Saudi Arabia, have deposited billions of their own money into your central bank.
Show us you have backing.
Right. That proves to us that you have support and won't immediately go bankrupt.
So it's the sovereign equivalent of having a rich uncle co-sign your loan. If the uncle's money is in the account, the bank approves you.
Yes, exactly. But now there's reporting by Nikki that Pakistan has repaid those deposits. And the report explicitly hints at cracks in ties between the two nations.
Uh-oh.
Yeah. This is a direct assault on the underlying financing architecture of Pakistan's entire IMF program. If the rich uncle pulls his deposit, the cosign is gone. The pillar holding up the whole structure has visibly shifted.
But wait, I don't get this. I really have to push back here because everything I read on the news apps all week was just praising Pakistan. Like, they stepped up, they played a major mediator role in the region to help get this ceasefire done.
They did.
And usually the market loves that kind of geopolitical goodwill. It creates a narrative premium, right? Doesn't that buy them some grace with bondholders? Like, why aren't they being rewarded for keeping the region stable?
It's an incredibly seductive narrative, and it is exactly the trap the Amnesiac Rally falls into. Markets love a good peacemaker story, but diplomatic goodwill does not pay off maturing bonds.
Ouch. Yeah.
The Dispatch makes it very clear. Whatever narrative premium Pakistan earned as a mediator is now functionally useless because it's completely offset by the loss of this actual hard currency financial buffer.
Right. Because you can't pay a bond coupon with good PR.
You cannot. And the timing is what makes this an absolute crisis. Pakistan has a massive maturity wall of debt looming in 2026 and 2027.
Oh, wow. So right around the corner.
They have huge bills coming due. Having your key bilateral creditor pull back their deposits right as you approach a mountain of maturing debt is not just a footnote. It is a structural escalation.
Wow. Okay, so we've looked at the casualties of this shock. India quietly draining the tank, Turkey pawning its assets for stability, and Pakistan watching its co-signers just walk away. Did anyone actually survive this stress test with their fundamentals intact?
Well, there is one.
Because the Dispatch pivots over to the Mekong region, specifically Vietnam, and they look like they were wearing armor during this whole event.
The contrast Vietnam provides is illuminating. Unlike the energy-importing sovereigns in South Asia that were scrambling, Vietnam has a fundamentally different economic engine. If we look at their October 2025 IMF Article 4, the defining feature is their export-oriented growth strategy and a massive, consistent current account surplus.
Meaning they consistently sell way more to the rest of the world than they buy.
Correct. And that surplus acts as a structural buffer. Now, creating a massive export economy comes with its own long-term domestic imbalances, absolutely. But in the face of an external energy price shock, having a fire hose of dollars constantly coming in from manufacturing exports provides an incredible shield. You don't have to drain your reserves to pay for expensive oil if your factories are generating fresh dollars every single day.
That makes total sense. And the dispatch also highlights a political element, the political consolidation under President Talam. Now, obviously, regardless of how anyone feels about the domestic politics of a one-party state tightening its grip, we're just looking at this purely from the cold, hard perspective of a sovereign bondholder.
Purely financial.
Right, and from that angle, that consolidation just looks like institutional stability.
Right. From a credit analysis standpoint, yes. It's a variable that reinforces the likelihood that policies won't radically shift overnight. Because of that export buffer and that institutional continuity, the energy shock that absolutely consumed the reserves in India and Turkey arrived in Hanoi as just a dampened signal.
Barely a blip.
Relatively speaking, yeah. In fact, relative to the IMF's baseline projections, Vietnam is actually showing a mild positive deviation. They weathered the storm better than the economic models predicted.
But every region has its weak link, right? If Vietnam is the fortress, their neighbor Cambodia is flashing red.
Definitely.
The dispatch points to reporting from Nikkei Asia about jitters in Cambodia's banking sector, reflecting concerns over the wider real estate economy. Now, jitters sounds like a polite, mild word, but for you listening, Cambodia is basically acting as the canary in the coal mine for the whole region's underlying stress. Why is Cambodia so uniquely vulnerable right now?
Well, Cambodia is caught in a fascinating and highly dangerous structural trap. Their banking system is heavily concentrated in real estate, which is notoriously illiquid, especially in a downturn. But more importantly, the entire economy is almost completely dollarized.
Meaning they literally just use U.S. dollars for everyday transactions.
For almost everything, yes. Bank deposits, loans, daily commerce, it's mostly in dollars. And the mechanical consequence of that is severe. The Cambodian central bank completely lacks a modern monetary policy toolkit.
Wow. So it's like trying to drive a car on a treacherous mountain road, but the steering wheel and the gas pedal are being controlled by someone sitting thousands of miles away in Washington, D.C. at the Federal Reserve.
That is the exact dynamic. When a massive shock hits, a normal central bank can devalue its own currency to make exports cheaper and absorb the blow. Cambodia can't do that.
This is not their currency.
Exactly. A normal central bank can create money to inject liquidity into a freezing banking system, acting as a lender of last resort. Cambodia can't print U.S. dollars, and they can't adjust the underlying price of credit to manage the shock because they don't set the rates. They are structurally rigid.
So if a real estate bubble starts bursting, they just have to sit there and take the hit.
Pretty much.
But the dispatch argues that this matters immensely, even if you as an investor don't own a single Cambodian bond or real estate asset. Like, why should the broader market care about Cambodia's banking jitters?
Because it signals a systematically underpriced stress across the entire Mekong financial system.
Okay.
The IMF has already flagged declining investment trends across this subregion as a deep vulnerability. When you see banking stress manifesting in a rigidly dollarized economy like Cambodia, even at an early stage, it is the activation signal of that wider regional vulnerability.
It's the first domino.
Exactly. It means that corporate debt, quasi-sovereign paper in Vietnam, and credit instruments across the whole region carry a correlated risk that this current relief rally has absolutely failed to price in.
So bringing this all together, what does this actually mean for how we look at the world right now? Let's translate this into plain English and recap the final score straight from the dispatch's positioning register, because it paints a very clear picture of where the danger is hiding.
It does.
The stance is cautious on Pakistan's external bonds, because that ceasefire relief rally compressed spreads, meaning the bonds got more expensive to buy. But the price completely ignores the crumbling bilateral support from the UAE and that massive 2026 debt wall.
Right. The stance is also cautious on Indian local currency duration.
Let's translate that real quick for the listener. When we say local currency duration, we're talking about holding longer-term bonds priced in Indian rupees, right?
Correct. And the danger there is the invisible balance of payments adjustment we discussed earlier. Because they burned through so many reserves to artificially save the rupee, if a second external shock hits before those reserves are rebuilt,
Which could happen anytime.
right, then the RBI will be forced into a terrible choice. Either let the currency finally collapse, which destroys the value of those local bonds you're holding, or accelerate a reserve drawdown they mathematically just can't afford.
Brutal. And the dispatch is also cautious on Turkish local currency instruments, despite all the ceasefire euphoria.
Hmm.
Because that $20 billion sterilization intervention in March means their usable reserve position is much, much worse than the headlines suggest. The stability is entirely intervention financed.
It's a facade.
On the flip side, the dispatch is constructive on Vietnam's external bonds, thanks to that massive current account surplus acting as a shield. And finally, they're watching Cambodia's banking sector like a hawk as the leading indicator for regional contagion.
You know, the overarching lesson here is really about identifying where true asymmetry lies in the market.
Yeah,
When the relief trade, the Amnesiac Rally becomes the consensus, everyone piles into the exact same side of the boat. They celebrate the receding threat. But the residual risk, the accumulated structural damage, is left completely unpriced. And that is exactly where the greatest danger and the greatest opportunity resides for someone willing to look closely at the mechanics.
which brings us back to why this deep dive is so important for you, listening right now. It's about seeing those hospital bills hiding right behind the ticker tape parade. And I want to leave you with a final, provocative thought that builds on what we've unpacked today.
Okay.
We know it takes quarters, maybe years, for a central bank like India's to rebuild its financial reserves through exports. You can model that timeline on a spreadsheet. But the dispatch noted something much harder to quantify. Bilateral creditor relationships like the cracking foundation between Pakistan and the UAE are built on a completely different kind of asset. They're built on trust.
That's the crux of the issue. A central bank can slowly accumulate foreign exchange. But how does a sovereign nation mathematically rebuild broken trust once a geopolitical relationship fractures?
Exactly. If financial reserves take quarters to rebuild, how long does it take to repair trust between nations when push comes to shove? And more importantly, how can a bond market, which is obsessed with algorithms and immediate relief, possibly price the evaporation of trust into a spreadsheet?
It can't.
It just can't. The bleeding might have stopped today, but the body is still drastically weakened. And until the market realizes it needs a transfusion, not just a bandage, the risk is still out there. Thank you so much for joining us on this deep dive, for looking past the amnesia, and we will see you next time.